The billionaire investor Ronald S. Barron flashed the grin of a proud father at his annual investor jamboree in November, as the chief executives of his favorite companies explained how slashing prices stoked their bottom lines. That is, until a shareholder in one of his mutual funds drew an awkward parallel. "Excuse me, Schwab is charging a very low fee," a woman pointed out, after a presentation by Walter W. Bettinger II, the chief executive of the discount broker Charles Schwab. God bless him, but no one ever said Barron's fees are little. You can say that again. Mr. Barron's mutual funds charge some of the higher investment fees around, and the fees have held steady despite a $1 trillion exodus out of old-school mutual funds into cheaper, better-performing rivals that track a variety of indexes and investment styles. In a global economy where competition and Amazonian price destruction have forced companies to cater to cost-wary customers, the mutual fund industry is a rare outlier. Fees on most actively managed mutual funds, which house the retirement savings and other assets of millions of Americans, have barely budged. The reasons for that: quiescent mutual fund boards, complacent investors, and a general unwillingness to call a halt to one of the great gravy trains in financial history, are all visible inside Mr. Barron's fund family. The Barron Funds Group manages $26.4 billion in assets on behalf of hundreds of thousands of small and large investors. An old-fashioned stock picker, Mr. Barron achieved renown in the 1990s and the 2000s for successfully betting on small companies. But his performance has suffered in recent years. In 2014, 2015 and 2016, his flagship fund, Barron Growth, trailed the Standard & Poor's 500 stock index by an average of 7 percentage points. This year, the results have been better. He is up 27%, compared with 20% for the S&P. The 13 Barron funds impose fees that were 54% higher than last year's industry average, and vastly higher than what a comparable exchange-traded fund would charge. In November, Barron reduced fees on 3 of its smaller funds. But the largest, Barron Growth, with $6.3 billion in assets, still charges 1.3% of assets. That is a third higher than the median level for similar funds, according to Morningstar. Since 2010, investors have withdrawn, in net terms, just over $5 billion from the Growth Fund, according to Morningstar. But many have stuck around. Mr. Barron, 74, is perhaps best known for his annual investment conference, now held at the Metropolitan Opera House at New York's Lincoln Center and in its 26th year. Mixing rock stars, pop entertainment, Barbra Streisand and Paul McCartney have performed in the past. Patriotism, this year celebrated the 100th anniversary of President John F. Kennedy's birth, and triumphant chief executives. The gala is a giddy ode to American capitalism. Few fund companies offer a comparable perk, and some 5,000 Barron fund holders travel to New York to attend. At the conference in November, with markets hitting new highs each day, investors were exultant. But there was a lingering concern.